Listen, stop everything you are doing right now because what I'm about to tell you is going to fundamentally change the way you understand your money, your savings, and the entire global financial system that you have been told is working in your favor. I have spent over 20 years watching gold and silver markets from the inside, tracking price movements that the mainstream financial press refuses to explain honestly, and what just played out on the global stage with the United States launching military strikes against Iran on February 28, 2026, has confirmed something I have suspected for years, but could never fully prove until now. The entire framework you have been given to understand wealth and financial security is not just outdated, it is designed to keep you in the dark. And the people who understand what is actually happening are moving right now. They are moving fast. They are moving quietly. And if you do not understand what I'm about to walk you through, you are going to be standing in the exact wrong place when the next phase hits. So stay with me because everything I am about to tell you connects, and by the end you are going to see the picture they absolutely do not want you to see. Let me start with what just happened, because the surface story is not the real story. On February 28, 2026, the United States launched coordinated strikes against Iranian military installations and nuclear infrastructure. Multiple sites hit simultaneously. Air defenses degraded within hours. Washington framed it as a necessary preventive action. The Allies were briefed. The United Nations convened emergency sessions. Every headline focused on the smoke, the missiles, the geopolitics of American military power. That is the story they gave you. Here is the story they did not give you. The real story is what happened in the 72 hours after those bombs fell. The single most important economic relationship in global energy, the $400 billion strategic partnership between China and Iran, did not break. It did not fracture. It did not even pause. While every Western government was issuing statements, while NATO allies were running emergency consultations, Beijing was already on the phone. Not with Washington, not with the United Nations, with emerging political figures in post-strike Iran. And the conversation was not about war or retaliation. It was about oil contracts, about making sure energy cooperation agreements stayed intact, regardless of how the political transition unfolded. China issued a formal statement opposing unilateral military action, diplomatic language carefully calibrated to signal disapproval without triggering escalation, and then went right back to business. That moment should terrify every person holding their savings in dollars and nothing else, because what it revealed is the actual operating system of 21st century power, and that operating system has nothing to do with military alliances or treaties. It runs on dependency, on resources, on physical commodities that the entire global economy needs to function. And sitting at the center of that system, moving quietly, accumulating while everyone else is distracted by headlines, are gold and silver, the assets that cannot be printed, cannot be sanctioned, cannot be frozen, and cannot be degraded by the very governments that are supposed to protect your wealth. But here's where it gets wild. This did not start in February 2026. This pattern has been running for 75 years. In 1949, when China was founded, every nation was being pressured to pick a side in the Cold War. Align with America or align with the Soviets, that was the rule. China looked at both options and effectively declined. Yes, Beijing signed a friendship treaty with Moscow in 1950, but it was not a mutual defense pact. China never committed to sending troops if Moscow went to war. The friendship was real. The military obligation was deliberately absent. Then came the 5 Principles of Peaceful Coexistence in 1954. They sounded like diplomatic boilerplate, but buried inside was a strategic logic most Western analysts completely missed. If you do not interfere in anyone else's affairs, nobody can demand you take sides when their crises explode. You maintain maximum freedom of movement. You preserve the ability to deal with everyone simultaneously. When the Soviet Union collapsed in 1991, the implosion was total. Every country formally tied to the Soviet alliance system paid the price. Cuba lost subsidies. Eastern European economies went into freefall. Former Soviet republics were shattered overnight. China, which had broken with Moscow 30 years earlier and built no comparable alliance structure, absorbed none of that fallout. None. It watched from a distance, stable, growing, entirely unaffected because it had no formal ties to sever, no obligations to fulfill. The isolation the West had mocked for decades turned out to be insulation, and the decision nobody understood in 1949 began looking like the most far-sighted strategic call of the 20th century. Now stay with me because this is where the gold and silver story enters hard. What was China doing during all of this? What was it accumulating while the rest of the world was managing alliance commitments, fighting expensive wars, maintaining 800 military bases across 80 countries? It was buying gold, quietly, relentlessly, systematically, in quantities that Western financial media consistently underreported because the full picture was too alarming. In 2000, China's officially reported gold reserves were approximately 400 tons. By 2008, they jumped to over 1,000 tons, an increase Beijing did not disclose for years. By 2019, over 2,000 tons officially. And those are just the numbers Beijing chooses to report. Multiple credible analyses suggest actual Chinese gold holdings, including state-owned enterprises and undisclosed reserves, could be significantly higher. Some estimates exceed 5,000 tons. The direction is unambiguous. China has been accumulating gold for over 2 decades without interruption, through financial crises, pandemics, trade wars, every disruption of the 21st century. And it has accelerated in precisely the periods when global instability was highest. Ask yourself why. Why would a country with the second largest economy on Earth, holding over $3 trillion in foreign exchange reserves, choose to pour resources decade after decade into a metal that the mainstream Western financial industry has spent 50 years calling a relic? The answer is the same answer that explains everything else. China does not trust the dollar-based financial system. China watched what happened when Russia's central bank reserves were frozen in 2022, $300 billion in assets frozen overnight by executive decision. That single act sent a signal to every central bank on the planet. If you hold your reserves in dollar-denominated assets inside the Western system, those reserves are only yours as long as the political relationship holds. The moment the relationship breaks, your savings can be weaponized against you. The only reserves that cannot be frozen or sanctioned are reserves that exist outside the system entirely. Physical gold, held domestically, in vaults no foreign government controls. This is why gold has been rising relentlessly, past $2,000 an ounce, past $2,500. At each level, the mainstream media said it was a top, said it would correct, and at each level, central bank buying absorbed the supply and the price moved higher. Because the bid underneath gold is not speculative. It is structural. It is sovereign. It is nations protecting themselves against a system they no longer trust. But let me put the silver story specifically in front of you, because silver is where I believe the greatest asymmetry exists right now, and almost nobody is talking about it honestly. Silver is not just a precious metal, it is an industrial metal used in solar panels, electric vehicles, electronics, medical devices, 5G networks, water purification. Over 50% of annual silver demand comes from industrial applications. And that demand is increasing every single year, while mining supply has been essentially flat. New discoveries are rare, existing mines are depleting, extraction costs are rising. The result is a structural deficit. The world is consuming more silver than it is mining. That deficit has existed for several consecutive years, and it is being filled by drawing down above-ground inventories that are finite, measurable, and declining rapidly. The gold-to-silver ratio right now sits above 80-1. The historical average is between 40 and 60-1. In periods of monetary stress, it has compressed to 30-1 or lower. The last 3 times the ratio was this extended, silver subsequently moved faster and further in percentage terms than gold when the correction came. And the fundamental case for that ratio compressing again is stronger now than at any point in the last 50 years, because the industrial demand component did not exist at this scale before. Solar alone consumed over 140 million ounces in 2023. Every government committed to green energy transition has implicitly committed to increasing silver demand, whether they realize it or not. Now, here is the piece that ties everything together. The Western alliance model is not just a geopolitical structure, it is a financial structure. The dollar's reserve currency status exists because the United States provides security guarantees worldwide, and in exchange, those countries hold reserves in dollars, price commodities in dollars, conduct trade through dollar channels. The dollar is not backed by gold since 1971. It is backed by the system, by the alliances, by the military commitments, by the implicit promise that America will maintain the global order. But what happens when the system cracks? The United States maintains an alliance system costing nearly $900 billion a year. To fund it, Washington runs massive deficits. To finance those deficits, it needs the world to buy its debt. The world buys that debt because the dollar is the reserve currency. The dollar is the reserve currency because of the alliance system. But every time that system produces a crisis, every time Washington is forced to act, the cost increases, the debt grows, and more central banks quietly move reserves out of treasuries and into gold. And every time they do, the foundation under the dollar gets thinner. It is a death spiral in slow motion. And the people who manage the system know it. The BRICS nations are actively building alternative payment systems. Cross-border transactions are increasingly settled outside the dollar. Saudi Arabia has been publicly considering accepting yuan for oil. Each development individually seems manageable. Collectively, they represent the most significant challenge to dollar hegemony since Bretton Woods, and every single one increases the strategic value of gold and silver. Because in a world where the dominant currency is being diversified away from, assets that have served as money for 5,000 years become more relevant, not less. They become the neutral ground. The store of value that depends on no alliance system, no treaty, no political arrangement. Central bank gold purchases hit record levels in 2022 and have remained near those levels since. China, Poland, Singapore, Turkey, India, the Czech Republic, multiple central banks across the developing world have been adding gold at a pace not seen since the 1960s. And what are they reducing? Dollar holdings. Treasury holdings, the very assets the United States needs the world to keep buying. The Iran strikes accelerate all of this. Energy prices spike. The Persian Gulf risk premium resets higher. Higher energy costs mean higher input costs across every sector. Higher input costs mean persistent inflation. Persistent inflation means the real value of cash continues to erode. And in that environment, gold and silver do not decline. They rise. Because they are the only monetary assets in history that have maintained purchasing power across centuries, across empires, across the rise and fall of every fiat currency ever created. Let me address what the skeptics will say, because I need to inoculate you against arguments deployed by institutions that benefit from you staying inside the system. They will say gold and silver have no yield. True. Also irrelevant. Yield is a feature of the system. When the system is stable, yield compensates you for staying inside it. When the system is fracturing, yield is the bait keeping you exposed to the very risk you should be avoiding. A 3% nominal return in an environment of 5 or 6% real inflation is not a positive return. It is a slow bleed dressed as income. Gold pays no yield. Gold also does not lose purchasing power. Over 25 years, gold has outperformed the S&P, outperformed treasuries, outperformed cash, purely through price appreciation driven by structural dynamics. They will say crypto is the new gold. I am not anti-crypto, but every cryptocurrency depends on infrastructure. Internet, electrical grids, servers, exchanges, digital wallets that can be hacked, shut down, or regulated out of existence. In a world of increasing instability, an asset that exists purely in physical form, requiring no electricity, no internet, no counterparty, and no government permission to hold, becomes stronger, not weaker. Gold and silver have been money for 5,000 years. Bitcoin has existed for 15. I know which track record I trust under real pressure. They will say the government will never allow the dollar to fail, that the Fed will always step in, and governments will try. But the tools available, rate manipulation, money printing, market intervention, work by adding more of the very thing causing the problem. More debt, more printed money, more claims on an over-leveraged future. Every intervention buys time but does not solve the problem. It makes the eventual resolution larger and more violent. What I believe happens over the next 12 to 24 months is this. The inflationary impulse from Iran works through the global economy because the Gulf risk premium has been structurally reset. De-dollarization accelerates as more nations diversify away from dollar dependence after watching unilateral American action against a country with deep ties to the world's second largest economy. Central bank gold buying continues at or above record levels because the structural incentives have intensified, and the silver market approaches a physical inflection point where the combination of rising industrial demand, stagnant supply, declining inventories, and increasing monetary demand creates a setup with no historical precedent. The last time silver moved aggressively in 2011, it went from roughly $17 to nearly $50 in about 8 months. That move occurred without the industrial demand being anywhere near current levels, without the central bank buying trend, without the geopolitical instability, without the de-dollarization momentum that exists today. I am not predicting a specific price target because that would be intellectually dishonest. What I am telling you is that the structural setup for silver right now is the most compelling I have seen in over 2 decades. The world is changing. February 2026 is not an anomaly, it is an acceleration. The pattern China established 75 years ago, maximum flexibility, no binding alliances, economic dependency instead of military obligation, relentless accumulation of real assets is proving itself in real time. The pattern the West established after World War II, alliance networks, treaty obligations, reserve currency privilege, military bases everywhere, is showing its age, its cost, and its fragility. Now let me tell you something that I have never shared publicly before, because until the Iran strikes I was not sure the timing was right. But the events of February 2026 removed any remaining doubt in my mind, and I would rather speak too early and help people prepare than stay silent and watch them get destroyed by something they never saw coming. What I'm about to walk you through is the mechanism, the actual plumbing beneath the surface of the precious metals market that determines whether the price you see on your screen reflects reality or whether it is a carefully managed illusion designed to keep you from understanding what physical metal is actually worth. Most people think the price of gold and silver is set by supply and demand in the physical market. Miners dig metal out of the ground, refiners process it, dealers sell it, buyers purchase it, and the interaction of those forces produces a price. That is how it should work. That is not how it actually works. The price you see quoted on financial terminals, the spot price that every dealer in the world references when you walk in to buy an ounce of silver or a gram of gold, that price is set on futures exchanges. Primarily the COMEX, which is a division of the CME Group in Chicago. And on those exchanges, the overwhelming majority of contracts traded are not settled by the delivery of physical metal. They are settled in cash, paper claims on metal that may or may not exist in the quantities represented. Let me say that again because it is the single most important thing you need to understand about this market. The price discovery mechanism for physical gold and silver is dominated by paper contracts that never result in physical delivery. The ratio of paper claims to actual registered physical metal available for delivery on the COMEX has reached levels that, in any other market, would be considered a systemic risk. At certain points over the last 3 years, for every ounce of registered silver available for delivery, there have been multiple paper claims outstanding. The exact ratio fluctuates, but the structural reality does not change. There is far more paper silver in the system than there is physical silver backing it. But here is where it gets critical. This paper market structure has allowed the price to be suppressed, or at minimum managed, for years. Because if you can create unlimited paper claims on a finite physical commodity, you can absorb buying pressure without the price reflecting the actual tightness of the physical market. Large institutional short positions on the COMEX, concentrated in the hands of a small number of bullion banks, have consistently exerted downward pressure on the price at precisely the moments when physical demand was surging. This is not conspiracy theory. The data is publicly available. The Commodity Futures Trading Commission publishes the Commitment of Traders report every week. Anyone can see the concentrated short positions. Anyone can see who is holding them. And anyone with a basic understanding of market mechanics can see how those positions function as a price ceiling. But here is the part that the institutions running this structure do not want you to understand. The paper market only works as a price management tool as long as no one calls the bluff. As long as the majority of futures contract holders are content to settle in cash, the system functions. The paper price can diverge from physical reality for extended periods because nobody is demanding the actual metal. The moment that changes, the moment a critical mass of buyers says, I do not want cash settlement, I want my metal, give me the physical silver or gold that this contract represents, the system faces a choice. Deliver the metal it may not have in sufficient quantities, or fail. And if it fails, the paper price becomes meaningless overnight, and the physical price, the real price, the price determined by actual scarcity of actual metal, reasserts itself violently. This is not theoretical. We saw a preview of it in early 2021 when a wave of retail investors attempted to squeeze the silver market. The response from the system was immediate and aggressive. Trading restrictions were imposed, margin requirements were raised, the narrative was aggressively managed to discourage further buying, and the paper price was defended, successfully that time, but the physical market told a different story. Premiums on physical silver, the amount you actually had to pay above the spot price to acquire real metal, exploded. Dealers ran out of inventory. Delivery times stretched to weeks. The paper price said silver was $26 an ounce. The real-world price to actually acquire physical silver was $35, $38, sometimes $40 an ounce, depending on the product. That divergence is the signal. It is telling you that the official price is managed and the real price is higher. And every time physical demand surges, that divergence reappears and widens. Now connect this to the geopolitical picture I have been drawing for you. Central banks are buying gold at record levels and taking physical delivery. They are not buying futures contracts and settling in cash. They are taking the metal home and putting it in their own vaults. They are doing this because they understand exactly what I just told you. The paper market is a price management tool. The physical market is where reality lives. And when the system comes under enough stress, it is the physical holders who are protected and the paper holders who are exposed. Silver is in an even more precarious position than gold because of the industrial consumption I described earlier. Gold that is bought and held remains available. It sits in vaults. It can theoretically be mobilized. Silver that goes into a solar panel is gone. Silver that goes into electronics is effectively unrecoverable at current prices. The above-ground investable supply of silver is being consumed by industry at the same time that investment demand is rising. And the COMEX registered inventory, the metal that is actually available to settle futures contracts, has been drawing down consistently. Each withdrawal reduces the cushion between the paper market structure and physical reality. Each withdrawal brings the system closer to the point where the bluff gets called. I do not know exactly when that point arrives. Nobody does. But I know the direction of every single variable involved. Industrial demand is rising. Mining supply is flat. Inventories are declining. Geopolitical instability is increasing. Central bank buying is at record levels. De-dollarization is accelerating. The paper-to-physical ratio is stretched. And the events of February 2026 have just added another layer of energy price inflation and geopolitical risk to a system that was already under structural stress. Every one of those variables points in the same direction, and the direction is up, not gradually, not politely. When this market moves, when the physical reality finally overwhelms the paper structure. It will move in a way that catches the vast majority of people completely unprepared. This is why I do not wait for permission. This is why I do not wait for the mainstream financial media to confirm what the data already shows. By the time they confirm it, the move will be underway and the metal will be unavailable at current prices. The time to position yourself is before the crowd arrives, not after. Because once the crowd arrives, premiums explode, inventory vanishes, and the opportunity that existed becomes a story about the one you missed. Let me tell you one more thing that keeps me up at night, and then I will tell you exactly what I am doing about it. The national debt of the United States now exceeds $34 trillion. The annual interest payment on that debt has surpassed $1 trillion. That means the United States government is now spending more on interest payments alone than it spends on national defense, more than it spends on Medicare, more than it spends on any single discretionary program, and that interest cost is calculated at current rates. If rates rise further, because inflation proves stickier than the Federal Reserve wants to admit, the interest burden grows. If the debt continues expanding, which every credible projection says it will, the compounding effect becomes mathematically inescapable. There is no realistic scenario in which the United States government pays down this debt through economic growth alone. The numbers do not work. The gap between revenue and obligations is too wide and growing wider every fiscal year, which means the debt will be managed the same way every unsustainable sovereign debt in history has been managed, through currency debasement, through inflation, through the gradual and sometimes not so gradual erosion of the purchasing power of the currency in which the debt is denominated. This is not a prediction. This is arithmetic. And arithmetic does not care about politics, about elections, about which party controls Congress, or about what any central bank governor says at a press conference. The math is the math. And the math says the dollar buys less every year, has bought less every year for over a century, and will continue buying less every year for as long as the structural deficit persists. The only question is the rate of erosion, and the events of 2026, the military spending, the geopolitical instability, the energy price shocks, are all accelerating that rate. Gold and silver are not a bet against America. They are a bet on mathematics. They are a bet that the same forces that have devalued every fiat currency in human history will continue operating exactly as they always have. And they are the only assets I know of that have survived every single one of those devaluations intact. Not stocks, not bonds, not real estate. Not any asset class that depends on the institutional framework of the system that is being devalued. Gold and silver. Physical. In your hands, outside the system. That is what survives. I hold physical gold and physical silver. I have been accumulating both for years, not in ETFs, not in futures, the actual metal. Because when you hold the physical metal, your wealth does not depend on anyone else's promise, not a bank staying solvent, not a government honoring obligations, not an exchange having inventory it claims to have. It depends on the fact that these elements cannot be created from nothing, cannot be printed, and cannot be wished into existence by a central banker with a press conference. This is not about getting rich. This is about not getting poor. The people who see structural transitions early act early. The people who see them late pay the price. And the people who never see them become cautionary tales. Start small if you need to. Buy an ounce of silver, buy a fraction of gold, but start. Because the clock that started ticking 75 years ago, the clock that ticked when the Soviet Union fell, when Russia's reserves were frozen, when American missiles hit Iran and China simply asked about the oil contracts, that clock does not stop. It does not care whether you are ready. The exit door is still open, but it will not be open forever.